Hi, everybody. I want to really thank you for investing in yourself and investing in this program. I think you're going to find an absolutely fantastic way to trade that's going to serve you for the rest of your life, because once you learn how to do this, unlike other industries, the stock market really doesn't change. Investing, they may have new products, like recent years, ETFs have been very popular. So there's might be new products coming on the scene, but the basics of investing will not change. They will be the same pretty much forever. And once you learn how to master this program, you're going to be able to not only have the confidence to trade on a daily, weekly, monthly, yearly basis for the rest of your life, but this is a type of program that you can hand down to your children and your grandchildren, because the basics of what we're going to be covering and even the advanced techniques that we're going to be covering are not going to change. They're going to be the same forever. I just want to say that, first of all, I don't know what your experience is in investing and trading. You may be very, very new to investing and trading, and that's fine. I think that you need to go out and purchase some very basic books on options. You need to understand what an option is, because that's what we primarily use for trading in our monthly income component of this business. The second thing is that you probably won't need any more than the basics. So a single book on options is all you're going to need, and I don't want you to get totally confused about that, because we are going to cover everything just beyond the basics here. Everything that you're going to need is in this trading program. The only thing that you might want to do is pick up a very, very basic book on options just to get familiar with what an option actually is. But we're also going to cover option fundamentals for just a few minutes, so you may not even need that. But it does help, and I found it really does help when I learn new material, is to find many different books on the subject as I possibly can. Both older books and newer books, and anything that I can read on a topic. When I get into a subject, I normally read between 5 and 10, sometimes even 15 books on the subject itself, even though you might be involved in this core program here, and you'll really get all the information that you need in this program. But in order to round out your education, you might want to pick up a few books just to get familiar with the way other people might look at the trading and investing, especially the use of options in trading and investing. And it's been my experience also that when I find a program that really, really works, and I find something that is so excellent that I get really, really excited about it, and I really want to test it out, I tend to get comfortable with the material and then start to get creative with it. I start to think of ways that I could expand the program, or maybe because of the other things that I've read, go away from the program and say, oh, maybe I could do this, or maybe I could do that, or maybe I could do something else. And when you start to get creative, then you're at the point where you're really going into uncharted territories, and I can tell you that you will eventually come back to this program again. You'll get so excited by this program that you may go out and read all kinds of other materials. You might even go to seminars. You might even go to workshops, or anything that you can find, because you've got this newfound knowledge and you're so excited about it that you want to learn as much as you can. And that's great. That's really, really great. But I know for sure that once you try other programs, I guarantee it that you'll come back to this program because it is the most profitable way to trade. Since 1985, I have been trading all kinds of different systems. I've traded option contracts, I've traded stocks, I've used systems, I've used technical analysis systems, I've used just about any type of system that you can possibly think of. I've gone to the seminars, I've gone to all kinds of different workshops and online seminars and webinars, and in programs, free programs, programs that cost $5,000 for 2 days, and I've gone to all of them. And I can tell you with a great deal of confidence that the system that you have in your hand right now beats them all. This is the very best system for you to make money on a consistent basis and also build long-term wealth. So that being said, we're going to go through, this is an entire system, we're going to go through every aspect of trading that you could possibly think of. And when we go into portfolio building, I'm going to show you a couple of different trades that seem to work out very well but are actually extremely dangerous. There's also, but a lot of what you're going to be learning during this program is how to select the very, very best trades that you can possibly pick without hurting yourself financially, but also has a very good risk to reward ratio, so that you are putting yourself in a position where you can actually build a very, very nice monthly income as well as long-term wealth. Okay. First, let's talk about so that's the goal of this program. And I want you to understand too that this program was really developed as a result of a retail trader who didn't find much success with all of the programs and systems that were out there. And then he found a very unusual system that really makes consistent profits in the market. And that is a system that you're going to be learning, because after 20 years of investing as a retail trader, there aren't many systems that you can really count on that will make both consistent monthly income and build wealth. So this is not from the standpoint of, you know, a market maker. Now, there's lots of guys out there who are teaching trading systems, and many of them purport to be former market makers or insiders in stock exchanges and so forth, and that's great. Except, you know, when I was going through seminars and I was going through webinars and things like that, it was really apparent to me that they had a level of knowledge as a market maker that didn't apply to retail investors like ourselves. And, you know, I was a retail investor. I'm not a market insider. And I needed that information translated down to a point where I could understand it and then apply it to my trading. And that was not easy to find. That was a little bit more difficult to find, is to take all the information in, apply it to my trading on a realistic and daily level. You know, what is it that I do on a daily basis or a monthly basis to select trades, monitor them, make adjustments if necessary, so that I remain profitable each and every single month. And I got a lot of theory, and I got a lot of a lot of cool stories about guys making millions of dollars in 3 days in the 1987 crash and so forth, which was really interesting. It's really nice and all that kind of stuff. But I am in my approach to investing in stocks and options is that I want to treat this as a business. I'm going into business for long-term profitability, and I want to build equity in my business, and I want a monthly income. And that's how I approach this. So let's talk about options for just a second, because if you don't know anything about options at all, you really need to have a firm grasp of what options actually are. Actually, options, when you think about it, I mean, they use the word option, but you can think of options are more contracts than they are anything else. They really are a contract. And a call, I mean, the definition of a call is really definition of a call option is a legally binding contract that allows the purchaser the right but not the obligation to purchase a particular number of shares of stock at a specified price, which is the same as a stock strike price, at any time prior to its expiration. And that's the one thing that you really need to understand about options, is that options do expire eventually. They may have value or they may have no value at expiration. But the one thing that you can be certain is that they will expire. Some of them are short-term options, some of them are longer-term options. You can purchase an option that expires the next day, or you can purchase an option that expires 3, 4, 5 years from now. So there are, if you think about options, an option is simply a contract. It's just an agreement between you and someone else. Now, if you're buying an option, if you're buying a contract, okay, that means that you believe that the price or the value of that contract is going to be higher at a future date than when you purchased it. The other side of the trade is someone who writes that contract, who sells you that contract. And that person believes that the price will be lower than in the future than it is at the time that they write it. And that's how they make their money. So you have one person on one side of the contract who believes that the contract is going to be more valuable in the future. You have a person on the other side of the contract who writes that contract who believes that the value is going to be less in the future. But it's not that one-dimensional. The fact is, the person who writes you that contract, who sells you that contract, may also hedge that contract with other options. So he may go into the market and place a corresponding trade on another option that hedges his risk in case he is wrong, and that contract actually goes up in value rather than down in value. So as an option buyer, you also want to be able to hedge your bets. One thing about being an option buyer is that, in fact, there's only really two absolute rules when it comes to being an option buyer. Number one is your contract will fluctuate in value. Number two is that contract will expire at some future date. Those are the only two absolute rules of options. Again, those rules are, number one, it will fluctuate in price. Number two, it will expire at a future date. If you think of options only as a contract, you're simply buying and selling different contracts. And you're betting really on the future value of that contract. It's been said a lot of times, and I know it's absolutely 100% sure and absolutely true that the stock market and the option markets is the biggest casino in the world, and it's right, except for one thing. When you go to a casino and you place a bet, let's say you go to the roulette wheel and you place a bet on black. Let's say you bet $100 on black and it comes up red. Well, you lose that $100. You don't get that back. You lose 100% of your bet. In the stock market, when you place a bet, let's say you buy an option contract. Well, number one is the price will fluctuate. That's the number one rule. The price will fluctuate. So what will happen is you can place a bet, a $100 bet on an option, and 3 days later, let's say the price has gone up. Well, not only do you get back your original investment, but you also make a small profit on that, or you may make a large profit on that. But you get back your original investment plus a profit if the price goes up. If the price falls, well, you get a portion of your investment back. You were totally wrong, but at least you get some of your money back. In the casino, if you're wrong, you don't get any of your investment back. So that's the major difference between the stock market and a casino, is that when you place a bet in the stock market, if you decide that you're very, very bullish on a particular stock, and you buy a call option that hopefully will increase in value as the stock increases in value. And if you're totally wrong and the stock falls, you can get out of that contract with at least some of your money back if you act prudently and quickly enough before expiration. So that is the major difference between the stock market and a casino. Now, what happens if so you have two types of options basically. You have the call option, which allows you to purchase a contract that gives you the right to purchase the stock at a particular stock price in the future. And then you have a put option, which is also a legally binding contract that allows you to the right, but again, not the obligation, to sell a particular number of shares of stock at any time in the future before its expiration, whether or not you own the underlying stock. And they may get a little confusing, but let's use this analogy. Let's say you own a home. Let's say you own a home, and you don't keep track of the market very well for your home, and other houses in the market, have sold recently, or they were sold in the past, and you had no idea, you didn't keep track of what they sold for and what prices people were getting for them. And someone knocked on your door one day and said, "You know what? I like your house. Would you be interested in selling it to me?" And you say, "Well, it depends, Look, I'm interested in buying your house for $1 million, but I'd like, what I'd like to do is say, I'm not really sure if I can get the financing or whatever, and I'd like 90 days to decide. But within that 90 days, I'd like the option to be able to purchase your property for $1 million. In exchange for you holding that property for me for 90 days, I'll give you a $500 deposit. And whether I buy the property or I don't buy the property, you get to keep that money." And boy, if you were the owner of that property, and you know that you only purchased that property for $300,000 just a few years ago, the prospect of actually selling your property for $1 million might be very attractive to you. So you enter into a contract with the person. He gives you a $500 deposit premium on the contract to hold the property for 90 days, and if he decides to exercise that option to purchase your property for $1 million, you'll have made a $700,000 profit. Now, the person who owns the contract, who wants to purchase your property, knows that there is a huge development going on near your home, and they're putting in, some super duper shopping center, and all of a sudden your property values are going up tremendously because this is a great place, and there's a resort going in there, and all of a sudden the properties in that area are going to double and triple in price, and you didn't know anything about that. So you took his $500, and now if he does not decide to come back and buy your property for $1 million within 90 days, then you get to keep that $500, and no harm, no foul. If he does come and purchase your property for $1 million, well, you've made a good deal of money on it, plus you kept the $500. The guy doesn't get that back, even if he does purchase your property. So that's really the analogy. I mean, the guy who's buying the option to purchase your property is hoping that values, or he'll be able to sell your property for even more than $1 million before that 90-day contract expires. And that's what he's betting on. But you know what? What happens to that contract over time? Let's say the start is today. He gives you the $500. You enter into the contract to sell your property to him for $1 million. Now he has the right to buy your property for $1 million, but he's not obligated to do that. So he doesn't have to buy your property for $1 million. Not like a purchase contract like you would when you buy your home, but this is just an option to hold the property and to buy it in a future date for $1 million. So he goes out and he tries to find someone else who is willing to take his contract and purchase your property for $1.2 million. So he's hoping to make a $200,000 profit on that property. If he finds someone who's willing to purchase your home for $1.2 million, he comes and he before the 90 days is up, he tells you, yes, hey, guess what? Hey, I'm going to buy your property for $1 million. And you are ecstatic. You are very, very happy about that. So he buys your property for $1 million. He already has a buyer for $1.2 million. He turns around and sells it to them for $1.2 million, making a $200,000 profit himself. And you have $1 million in your pocket where you can go out and buy another property. But what happens if he can't find a buyer? Well, if we started the contract today and 90 days later it expires, what happens to that contract over time? Well, if the 30 days pass by and he still hasn't found a buyer higher than the purchase price that he's asked you that you'd be willing to sell it for, then the value of that contract should actually go down a little bit. So instead of it maybe originally it was worth $500, now maybe it's only worth $450 because 30% of the time has expired, has eroded that contract to the point where now instead of 90 days in which to find a buyer, he only has 60 days in which to find a buyer. So the probabilities of him actually finding a buyer at 90 days was much higher than it is at 60 days. And then let's say another 30 days has gone by and he has still not found a buyer for the property in which he can make a profit. Well, that contract now is worth even less money. Maybe it's only worth $250 because two-thirds of the time, 60 days have passed and he hasn't been able to find a buyer. So the contract that he has entered into with you is now worth less because there's a much lower probability that he is actually going to be able to find a buyer of $1 million or more. Actually, more than $1 million, because if he buys it for $1 million and he can only sell it for $1 million, he's not going to make any money, is he? So he needs to find someone who's willing to buy it for more than $1 million. And now 60 days have passed and he hasn't been able to find anybody. So that little contract that he has, the option to purchase your property, is going to be worth a lot less. Well, in the last 30 days, he still hasn't been able to find a buyer. And guess what? At 90 days after you originally entered into that contract with him, that contract date has expired and he hasn't found anyone to purchase the property for more than $1 million. But since he paid you a premium $500 and the contract expired, you get to keep that $500, and now you are no longer obligated to sell him the property for $1 million. So that's essentially what happens when you go to buy a call option, an option who is hoping to profit from the price increase of a stock. Let's take it for an example, IBM. And I'm going to go to my screen just for a second, and I'm going to show you what an option contract is selling for IBM. We'll go down here to options. We'll take a look at the current month of options, which is May. Now, remember, option contracts will fluctuate in price and expire at a certain date. Almost all option contracts expire the third week of the month in which they're being written. So the May contracts will expire the third Friday of the month in May. That is the last day that you can trade those contracts. At the close of business on the third Friday of May, you will no longer be able to trade those contracts, and the contracts will expire the very next day. So you're going to, let's take this May of 2008 90 price strike price option. If you were to buy a call option, you would buy it at $34.80. You can also sell a contract. In other words, just like the property owner, even though you do not own the stock, but the market gives you the right to sell a contract on a stock that you do not own. And you could sell that contract for $34.10. So, in other words, you can collect the premium, just like the option buyer who came to your property and gave you a $500 premium. You would collect that $34.10 on that option contract, and you get to keep it as long as the price of IBM goes below $90. It's at $90 or below. That's what makes option trading so much more flexible, because you can both be a writer of options and a buyer of options at the same time. And there's all kinds of strategies that you can use in order to profit not only from the expiration date of these options, but also from the fluctuation in the prices themselves. Most people who are speculators in the market buy what we call at the money options. So right now, IBM is trading at $124.40. The closest option to that price is the 125 option. And the 125 option is right now, if you wanted to buy it, it's $2.80. So a single contract, if you were to purchase a call option on IBM at the 125 strike price, you would pay $2.80 for one contract. However, one contract gives you the right to purchase 100 shares of IBM stock. So if you were to purchase one contract, let's just click on that as a buy, and we'll toggle this down to one contract. One contract of the 125 call option on the May expiration of IBM would cost you $280, because you are actually purchasing the right to buy not one share of IBM, but one contract equals 100 shares of IBM. So whatever the price of that option is, $2.80, you would have to multiply by 100 in order to determine your exact cost. So including your commissions of $2.95 for one contract, your total cost is $282.95. Now, how would you determine whether or not you would ever make a profit? Well, if IBM stock rose in price, okay, let's say it went up $5 tomorrow, and that's a distinct possibility, because IBM does move pretty quickly, and it does move in sometimes large numbers. How would you determine the price of the contract of the 125 strike price? See, if you purchase one contract of this May 08 125 contract on IBM, that gives you the right to purchase IBM at $125. Okay? The premium that you're paying, the $280 for that one contract, that one option contract that gives you the right to buy 100 shares of IBM, will expire the third week of May, the third Friday of May, to be specific. So right now, you're purchasing the right, but not the obligation to purchase IBM at $125. Now, what happens if you're right and IBM does increase in price? Let's say it goes all the way up to $145. Well, if it's at $145, as long as it's at $145 before the third Friday of May, you have the right to purchase the stock, 100 shares of stock, if you purchase one contract at $125. Cool, right? Because you could immediately exercise your option. All you have to do is sell your option at $125 and pocket the difference between $125 and $145 that the stock is currently trading at. That's $20 of profit. However, you don't keep all $20 of that profit because you paid $2.80 for that premium. You gave that to the seller of that option, and they get to keep that no matter what the current price is. So if your stock goes from $125 to $145, that's a $20 difference minus the $2.80 that you paid. So you've actually made a profit of $17.20. Okay? So, but what happens tomorrow if actually most people don't hold options that long? In fact, many people who are buying the at-the-money options for IBM or any other stock that has active options on it will hold it for just a few days. What happens if IBM goes up to $130 tomorrow? Well, you can simply take a look at what happens to this option if it goes $5 further in the money. And all of these options on this gray bluish screen are in the money. That means that the options are trading at a strike price below the current price of the stock. So if IBM were to go up $5 tomorrow to $130, then it's more than likely that all of these options here will shift to a higher price. So in other words, that 125 now will be in the money the same as this 120 is now because there's still a $5 difference between the two. So your $2.80 option will go to $6. So, but if you wanted to try to sell it, you'd get $5.80. So what's the difference between $5.80 and $2.80? $3. And that would be your profit if IBM went up tomorrow to $130. The problem with people who are speculating using options, and I'm talking primarily about the people who buy options to try to profit from the speculation of the stock going up or the stock going down. And we haven't talked about puts yet. Puts are actually options that you can also purchase if you believe IBM stock is going down. It works the same way as calls. The only difference is when you purchase a put option, you believe that the stock is going down. So if you were to purchase the 125 strike price option on IBM and you purchased one put for $3.60, if IBM fell $5, then this whole bluish gray in the money options would shift up $5, and you would have a profit of, if you were to sell it, of $6.60 minus the $3.60 that you purchased it for, and you would make a profit of $3. Okay? The problem with speculation like this is that what happens if you're wrong? Let's say you purchase this option for $3.60 and the stock moved up $5. Now the guy who bought the call option just made $3 profit, but what happened to your profit? Well, this will all shift down, and you know if the price of IBM is at $130, then your option that you purchased for $360, you're only going to be able to sell for $1.55. Now you've lost $2.05. How come you didn't lose as much as you would have made if the price went up? Well, there's lots of different reasons for that. Number one is the probability of if the stock did move down to 120, the probability that it would stay a little bit lower is higher than if it went up $5. So in other words, if you purchase the put option at $3.60, the stock dropped $5. Well, now your your option is now worth $6.60 if you were to sell it in the market. And the reason that it went up $3 is because now it's called in the money. In other words, the strike price of 125 now is $5 higher than the actual stock price. And the market makers consider that a higher probability that in fact it will expire in the money, that the option will expire at a point where it is profitable. However, as you can see, the lower you go, the less value these options have. The 120 option, which is about 5 points out of the money, which is $5 out of the money, only has a value of $1.65. Why does it have a lower value than the 125 option? Because the probabilities that the stock is actually going to be trading at $120 when it's currently at $124 on the third week of May when this option expires is less. And we can actually determine that. There's a number of different there's lots of information that you can get on each one of these individual options, including volume, how many actual contracts were traded on that particular strike price during the day. And this is the actual volume of trading that took place yesterday on IBM stock. You can see here that the May 120 calls, 2,247 contracts were traded. The May 125, 7,104 contracts were traded. The May 130s, 9,557 contracts were traded. So you can see that the majority of people will trade right around these at-the-money strike prices. But you can also get some other information about these options, including, let's see, what am I looking for? The probability of expiring. See, what happens is when you purchase an option that's in the money, you have a much greater, and we're looking at this column right here, the probability of expiration, a much greater probability that option will remain profitable and of some value the third Friday of the month based on its current stock price. As you move out of the money, the market makers are saying, you know what? This $105 option only has a 3.91% chance of being worth anything at all by the third week of May. Doesn't that make sense? It's currently about $20 away from the current price of the market. So the market makers are saying, look, you know what? We're only going to give that a 4% chance of being actually worth anything. That's why it's so cheap. You know, it's a very, very cheap option. But if you were to purchase that for 20 cents and IBM were to take a dive and fall below $105 or even get to the point where it's at the money, the at the money options are selling for $1.65. Well, your option that you purchased for 20 cents, and we can see that a 20-cent option is only $22.95, is now going to be worth $1.65 or $165. So you can see that you can buy an option for 20 cents, and in real terms it's $20 because you have to multiply it by 100 to get your real cost. Can easily be worth $1.65. Or $165, which is an incredible return on investment. And there are a lot of people who speculate that IBM may drop that far, and that's why they buy these options. But it doesn't have a very good chance of being worth anything at all. Now, IBM stock does fluctuate. There's no doubt about that. In fact, if we take a look at a chart of IBM, let me just bring this up for a second. Let's take a look at IBM's chart. You can see that IBM back in February, right around, maybe this is January here. Let me take a look. Yeah, let's go back. This is January right in here. In January, let's say around the 11th, IBM was selling it around $98, right down in here. If you thought the potential for IBM was to go up in price, you could have purchased an at-the-money call option on IBM when it was right around $98, probably for around, let's say if you purchased the February expiration options, probably right around where the current May options are. So maybe around $1.65, or let's see what they were selling for, $2.80. So let's say you bought a call option for $2.80. Well, from that time until the third week of February, in the third week of February, IBM was trading for right around $106. So the difference between $98 and $106 is approximately, if I do my calculations correctly, $8. So IBM rose in price by $8. Well, what would happen to that contract if you bought it for $2.80 and it went up $8? Well, it's going to be close to $10 in price because, you know, it's gone up almost $10. So it's going to be worth $7 or $8 minus the $2.80 that you paid for it. So you're going to make a profit of about $5. On the other hand, what if you thought because IBM had been going down in price, you thought that IBM was going to continue to drop, and you bought a put option for $1.65, and the price of IBM continued to go up and up and up and up? What then would happen to your put option? Well, your put option would go farther and farther and farther out of the money as the stock price continued to increase in price, and the market makers are going to value your options much lower because now it is so much farther away from the price that you actually bought it at. And the fact that it would have any value at all before the expiration of that option would be extremely low because it has moved so far away from the actual price that you purchased your option at. So if you purchased it at $1.65, the chances are if it moved $8 away from you and it increased in price, well, you know what? If you purchased your put option at 100 because IBM was trading at $98, well, now if the stock price is up around 120, your option is only going to be worth 10 cents. So instead of making $150, $160 on your contract, you've actually lost $150 on your contract. And not only that, but the closer you get to expiration, the longer it takes for IBM stock to move towards your strike price of your option, the less value it's going to have. Because remember, in our illustration of the person who purchased an option 90 days to purchase your house for $1 million and gave you a $500 premium, the person who sold that contract to you now realizes that, hey, guess what? You know, maybe you purchased that option 90 days before the expiration. Now it's only 30 days before the expiration. Well, there's less probability that the stock is actually going to be trading anywhere near $100 again, because now it's $124. So the option, because all options, remember there's only two rules in option contracts, that it will fluctuate in price and it will expire. So the closer you get to the expiration, the less value that contract actually has, because the probabilities of the stock actually moving in your favor have declined significantly. And if you understand those two rules, that option contracts expire and decline in value the closer they get to expiration, and the fact that they fluctuate in price, those are the only two things that you really need to know in order to profit from this system. Because what we hope to do, and what our strategy is all about, is, well, let me just say this first, is that let's say you purchase this option for 95 cents out here. Okay, your probability of that actually ever being worth anything is only less than 2%. But what happened to someone if they sold you that contract? You can remember I told you that even though you don't own IBM, you can sell contracts on IBM and collect the premiums, just like you're the owner of the house. Well, the person who sold that contract to the person who bought it has a 92%, no, higher than that, 98% probability that that option will expire completely worthless. What does that mean? Well, that means that the 10 cents that you collected for that option, as the seller of that option, there's a 98% chance that you're going to be able to keep all of it, and it will not be at a higher price. Because as a seller of the option, you don't want it to go a higher price. You want it to be lower because you're selling it. You want it to be at a lower price. But there's a 98% chance that it will be, in fact, at a lower price and expire absolutely worthless. Then you get to keep the premium that you received, 100% of the premium that you received for writing that option. So our goal in the entire strategy that I've built is all around collecting the premiums of and writing the premiums and selling these options to other people who are speculating on the fact that the price is going to go up or the price is going to go down. And our job is to create a strategy in which we collect the premiums from these options in a way that does not get us into trouble. Because, let me give you a warning, if you were simply to write these options, if you were simply to sell these options with absolutely no protection, and if IBM decided to go, get taken over by a much larger corporation, and I'm not sure if there is one, but if, let's say Microsoft decided to buy IBM and they were willing to offer them $220 a share, well, if you sold an option at $135 a share for 25 cents, and IBM or Microsoft came in and decided to buy IBM for $225 a share, well, all of a sudden your 25 cents turns into $100, and you will get killed. You will get absolutely killed on that trade, because 25 cents will turn into 10,000. Your $25 premium all of a sudden is worth $10,000, and you will have to pay out. You will have lost $10,000 because the owner of that contract, the person who purchased that for $25, will say, "Hey, I'm going to purchase IBM stock for $135. You got to deliver 100 shares to me now." And at $135, and you have to go into the market to purchase IBM stock at $225 or $235, you're going to be paying $100 more than you sold that contract at. So we never sell what they call naked options, options that do not have any protection on them. No. What we do is we provide, we create strategies, mostly through spreads, that allow us not only to collect the premium, but to protect ourselves in case of a takeover or something like that. And actually, most of our strategies do not focus around individual stocks. We tend to, almost all of our strategies are on indexes that can't be taken over because we do not want that price risk. So let's say we want to do something on IWM. IWM is the ETF for the Russell 2000 index. Well, nobody's going to take over the Russell 2000 index. There's 2,000 stocks in that index. One or two of those stocks may get a takeover bid, which may slightly affect the price of the index, but not dramatically. However, the prices, remember, there's two rules. Prices will fluctuate, and options they will expire. So let's say we wanted to capture 82 cents, or this May 74. We wanted to sell this option for 78 cents. Well, if we wanted to collect as much premium as possible, what could we do to protect ourselves? Well, if we thought there was some danger that the Russell 2000 index, which we can also take a look at a graph of, the Russell 2000 index now has been trading downward. However, it looks like it may be turning around. So if we think it's going to remain in some sort of trading range, all we have to do is sell this contract, collect 78 cents. But if we want to protect ourselves so that we don't get hurt if it does go up dramatically, then we can also buy a contract just slightly above our 74 cents, our $74 strike price. And now what we have is a spread. So in other words, if the Russell 2000 index does not go above 74, we get to collect and keep that entire 78 cents that we just sold that contract for. But we had to pay for protection, and that protection cost us 50 cents. So the difference between the 78 cents and the 50 cents is 28 cents, which we get to keep. That's how much we will get to keep. Now you say, well, why would you buy protection? Well, because, like I said, even with an index, the price can fluctuate dramatically. And if it goes up to 79 or 80, now all of a sudden the contract that we sold at 74, if it goes up to 80, is worth $6. And if it's worth $6, we've lost $5.22. So we'd have to pay out $5.22, which is not a pleasant thing to do. However, if we protected ourselves by buying the $75 contract, that $75 contract is also worth $5. So the maximum that we could lose on this contract is the difference between the 74 and the 75, which is only $1. So the maximum loss is not $6.22, but because we've protected our short position with a long position on the same underlying index, now the maximum loss is only the difference between these two strike prices, which is $1. And I can show you exactly how this works. Normally what we do when we go to enter orders like this is we would go and we would right click on these in the TOS platform. And what we're doing is we're selling a vertical spread. This is called a vertical spread. The same month, same index, and same underlying. As you can see, we're getting the difference between the 78 cents and the 50 cents. Now the natural price is 28 cents credit, but we can also try to get a little bit better. We want a little bit, if we wanted a little bit more credit, we could try it at the mid price. But the natural price, the difference between these two options is 28 cents. So we would get to keep that 28 cents. We're just going to keep this at one contract for now just to show you what we're going to be doing here. If we were to simply enter this, we would receive a credit of $22.10. We can also take a look at a graph. if we go to anywhere within this little red area here, right click on that and go to Analyze Duplicate Trade, we can actually take a look at a graph of what the profit of this would look like. Let me just go back here because I had some other things in there. If we go to, we want to take a look at how profitable it will be at expiration. And as you can see, we collected $22 after commissions, and you can tell that the price is right here, and as long as the price does not exceed 74, which is the exact strike price of our short option, the option that we're selling, as long as it doesn't go above that and the stock remains lower than that, we make the full profit amount. And it doesn't matter how low this stock goes, we collect the entire premium. It's only if it goes above the price at which we sold it that we begin to look at a potential loss situation. So we can graph all of our positions in the TOS platform. Normally what we like to do is not do one-sided trades like this, because what would happen if, for example, we sold the May 74 option, we bought the May 75 option as protection, like we're doing here. This little plus symbol in front of the number of contracts means that we're buying it, which it says here buy. We're selling one of the May 74 calls for a 28-cent credit. We get to keep that credit. But we normally don't do anything one-dimensional like that. We also like to take a look at the put side because, and this is one of the tenets of our system, is that we do not know where price is going. We just don't know. We maybe have some ideas. We take a look at this graph going back about a year, we can tell that the Russell 2000 index is, kind of going down, but, lately it's kind of been going up. So we don't really know what's going to happen to the price. And this is really critical to understand as far as the system goes. We do not try to predict price. Price fluctuates. That is the only rule. No matter what you say about any particular stock or any particular index, there's only one rule in the financial markets. Prices will fluctuate. And it doesn't matter how long you go back. You can go back 5 years. You can go back 10 years. Prices go up and they go down. They go up and they go down. Now you might be able to determine certain types of trends, like from 2000 to 2003, the trend was down. From 2003 up to about the middle of 2007, the trend was up. From 2007, mid-2007 to the present, the trend again is down. There's really, you can kind of determine what the trend is, but guess what? It doesn't matter what you determine the trend is. Prices, the only rule to prices is the prices will fluctuate. So we try to create trades based around certain parameters that we're determining that will help us to become profitable. But we do not try to predict price. In other words, if I'm looking at this IWM chart for the Russell 2000, I might say, well, you know what? We're starting to reach, if you know anything about technical analysis, right around the 72, 73 level, it's a potential here to this could be considered a resistance point. In other words, the Russell 2000 has come up against this line once, twice, 3 times, and this is the 4th time, and it's, it seems like it just can't break through to that point. Resistance points usually have been prior support points, and you can see that when the IWM Russell 2000 started to decline, it was, this price level here was a support. In other words, it held the price before and it went back up. It held it again here and then went back up. Then finally, when it broke through that price, it actually came back up, and all of a sudden the support that was here now becomes the resistance. That is more often than not one of the best technical analysis tools that the market that you could do on a market, is that prior support becomes resistance, and then if this price should break through this resistance point, it will probably become support again. Okay, that's one of the things that we kind of keep an eye on. We also keep an eye on, we don't do a lot with technical analysis, but in general, prices tend to move in channels. So we'll set up channels for stocks. They don't have to be exact, but what we like to do is we like to see where the high end of the price levels are headed and where the low end of the price levels are headed. And sometimes they break through and then they come back up, but they hit the price levels again and they come back up. You could look at this 2 ways. Number one, if we were to do any kind of technical analysis on a Russell 2000, we could easily say that, hey, it's in a downtrend channel and it's meeting some resistance at the 73 level, which means that it may go back down again. So, we don't try to predict price, but we do try to get a feel for where it is at the time. And that somewhat gives us some sort of indication of how we should be placing our trades. If we think there's a little more risk to the downside, well, instead of choosing the 68 puts to sell, maybe we'll go down and choose the 68 puts to sell. So it gives us a little bit more room on the downside. But as you can see, there may be support brewing right around the 68 level because it hit it here and it went back up, it hit it here and it went up. So 68 might be a good place to put our puts and sell our puts at this point, because it's formed a support point a couple of times when the market has gone down. Now, let's take a look at an analysis of what this position would actually look like. We'll right click there, we'll analyze duplicate trade. We'll go back to our trade tab and take a look at this trade as well, and we'll analyze this duplicate trade. Now what we've done is we've set up for ourselves a little bit of a profit area. This green line is what will actually tell you the maximum profit that this position will be able to generate at expiration of these options. Remember, options expire the 3rd Friday. Actually, the last trading day is the 3rd Friday of each month. The options expire the day after that. So that's why it's +1 at expiration. Expiration date in this case is, for May options, is the 16th. But that's the day that they actually stop trading, but the expiration date is the 17th. So all we have to do is take a look at, let's see, yep, it's actually the May 17th, which is the expiration of the expiration date of the option. So if we were to take these trades, this type of trade is called selling a vertical spread. We're selling a vertical spread for a credit. Now, what does this give us? What kind of advantage does this give us? What kind of trade advantage does this give us? Well, the people who we are selling the contracts to at 74 believe it's going to be the price is going to be at 74 or better. And the people who let me just change this here. Okay, live. The people that we're selling to think it's going to be at 74 or higher by expiration date. And the people who purchase from us the contracts at 68 on the put side believe that the market is going to drop, and the index price will be below 68 at expiration. And we don't care which way they go. To be honest with you, it doesn't matter to us who's right or who's wrong. The only thing that we want to do is to be able to profit from the sale of those contracts. And you can see that setting up a trade such as this gives us a break-even point of anywhere from 67.5 all the way to 74.5. That's a pretty wide range. In other words, we are taking advantage of the fact of the number one rule of the markets, that prices will fluctuate. We're not very good at predicting future prices. You can ask, you can ask anyone, I don't care how much experience they have in the market. It doesn't matter. No one can predict the future. No one. If anybody tells you that they can predict the future, run as fast as you can away from them, because no one can predict the future. The only thing we can do, like I said, is you can take a look at some general trends. You can take a look at some support and resistance points, and that's about the best you can do. I've gone through all kinds of different systems where they said, well, there's, you can predict 80% of the increase in the price of a stock, or you can predict the price of a stock 80% of the time. Okay, well, yeah, maybe you can predict it 80% of the time, but what about that other 20%? And then how do you trade that? So what we're doing is by creating the types of trades that we're going to be putting on in the system, we are giving ourselves a huge potential to profit, because we don't have to predict price anymore. The price, once we put this type of a trade on, it doesn't matter if the stock goes up or the stock goes down, because it could go down to 69, and guess what? We still get our full potential profit from this system. The only problem that we run into is when the price starts to come down, either towards our lower strike price or at the higher strike price. Then what we do is simply adjust. All we have to do is adjust our prices and adjust our contracts to take advantage of the new opportunities available to us if the price of the underlying stock reaches our break-even points. We never really have to be too concerned about price. And that is one of the biggest hang-ups and one of the reasons why the majority of people do not make money in the stock market. They are only playing price. And the only rule of the stock market, as I said, is that prices fluctuate, and that's all. And we cannot predict the future price. So once you put on a trade like this, the most important thing that you should understand is it will probably need adjustments. In other words, you're not going to be able to put on this position, and this is the way the majority of people who lose in the market do it. They put on a position like this, they leave it alone, they never see it again, and all of a sudden they look at their trades and they see that all of a sudden the index is trading at 78 and they're at their maximum loss position, and they say, this doesn't work. The technical term for this type of a trade is we're selling an iron condor. And you know what? They're going to say, that doesn't work. I've done iron condors because, boy, I put these things on and the price moved against me and all of a sudden I'm at my maximum loss point. And I did it 3 or 4 times and I'm never going to do them again because they don't work. Well, the reason that they don't work is because you don't manage your trades. There's one of the CDs that we're doing, of course, is on portfolio management. And we're also doing one on adjustments. Take a look at those. Take a look at what happens in a live trade. And that's the one thing that separates us from a lot of people who are teaching different strategies and so forth, is that we will show you live trades in our demonstration account. We're putting real money on the line on these things, and we'll show you exactly how to adjust them. For example, in one of the videos that you're going to see in the adjustment CD, I show you a SPY iron condor. Now, SPY is the S&P 500 Spiders ETF, and I'll show you that real quickly. And what happened was we put a trade on right down here, right when it was around 133.5, and all of a sudden it moved dramatically against us. And we had set our short call option up near the 140 level, and we almost got nailed right up against our 140 call. And we didn't get hurt because we adjusted it. Take a look at that to see how you can actually, and the reason that people do not make money in the market is because they don't know how to adjust. They put the trades on, they forget about them, they take the losses and move on, or they put them on, they adjust wrong. They adjust their trades in a wrong way that gives them an even worse position than they had originally. Where if they left the position alone, maybe they would have been okay, but they adjusted it in the wrong way and put themselves in some danger here. So we want to try to avoid that as much as possible. Let's take a little bit closer look at this graph. The analysis tool that Thinkorswim gives us is really a great tool because it allows you to take a look at exactly what the picture of profitability of this trade looks like. If this trade goes to expiration, which is the third Friday of May, and the stock stays, this index IWM stays in between 74 and 68, well, we make our maximum profit. How do we tell what our maximum profit is? If we move our cursor along this line, we can see right down here that the green line is the date of expiration, which is 5/17. We will make a maximum of $46 on this position. What happens is our current profit and loss is this white line. That's the profit and loss as of today on April 20th. Well, you can take a look at this and you can say, well, gee, we're right at 71.67 on the index, and our profit on this position, if we hold it all the way to expiration, is $46. But our current, even if we put this on today, we immediately lose. And you can take a look down here. We immediately lose $2.93. How can we, we just put this on. How can we lose the very first day? $2.93. We've already lost $2.93 on this position. We just put it on. Well, remember that when we take a look at this again, is that the difference between the bid and the ask is the reason that you are never in a profitable position the first day that you put these on. Because you're selling these at 78. Well, in order to close the position, you have to buy it back. So if you sold these at 78 cents and you bought it back at 82 cents, what's the difference between those two prices? It's about 4 cents. You're immediately losing 4 cents because of the bid-ask spread. That's what they call this, the bid-ask spread. So if you sell it at 78, you have to buy it back at 82. That's a 4 cent loss. You're buying the 75 calls at 50 cents. Well, if you wanted to sell them back, you'd only be able to sell them back for 49 cents. You lost a penny on that one. So you lost 4 cents on that one. You lost a penny on that one. There's 5 cents right there, and that's only one side of the trade. If you go to the other side of the trade, you've lost another 3 cents there, 4 cents there, and another on the 67s, you've lost another 3 cents there. So altogether, you've lost about 12 cents. Well, 12 cents times 4 contracts times 100 is close to $6. So you're lucky you're only losing 2, because actually, if you went into the market right at this moment, you'd probably lose 6. So, so that's why you would immediately lose money, and the reason is the bid-ask spread between the options. But that's okay. That's to be expected. Every time you put one of these positions on, you're going to lose money the very first day. But what we want to do, and what happens is, remember, there's 2 absolute rules of option contracts. Number 1, they will fluctuate in price. And the reason that we've put on a spread like this is because we've given it a lot of room for the price to move around in. It will fluctuate in price. So we've given it lots of room. The second absolute rule of option contracts is they expire. So what happens is today, yes, our option contract looks like this, our profit and loss looks like this, and we've lost $2.93. But over time, look what happens. This is today, the white line. This green line now has turned is about a week from now. Now, a week from now, all of a sudden, if our price remains relatively stable, all of a sudden we have a profit of, where is it? $4.15. Then, if we go all the way out to May 4th, which is just a couple weeks away, our profit is now $14.75. The options, remember, the options will expire. So, the further out, let's say if you buy a 90-day option, an option that expires in 90 days is going to be worth more money than an option that only has 30 days left to it, right? Because the closer you get to expiration, the less probability that option will actually have any value if the price remains relatively stable. If the prices, of course, prices do fluctuate all the time, so that price option contract is actually going to be worth more money at one point and less money at some point. Then, as we get very close to expiration, like 30 days prior to the expiration, well, all of a sudden at that point, then prices become, the option contract loses value on a daily basis. And let me just show you what it looks like on a real trade that we did. I can show you exactly what this looks like on a real trade. This is our green line, which is on a portfolio weighted basis, our entire position. And this white line, I mean, when we first put on the trade, it was way down here. You can see that we have the strike prices of the stock down here, and in this case it's the EEM, which is the emerging market ETF, and this is our profit and loss. We had a maximum profit of close to about $1,000 on this trade. We are just a few days from expiration. And our live price was $139.47. And this white line is our current profit position. When we got started, it was down here. But each day that we continued to hold this trade, it kept going higher and higher and higher and higher and higher and higher. And now at this point, we are about 1 week from expiration. If you take a look at the current live price down here where I've highlighted it, the important thing to think about is theta. We're going to go through each one of the Greeks in the next CD. because they're extremely important. This is where you make your money. The theta was $48.25, and all that really means is that for each day that passes, we have the option contract is declining by $48.25 each and every single day. If we take a look at our current profit and loss open, we have a $500 profit so far on this trade in just 2 weeks on this one on this one trade, and we are generating $148.33 in profit per day, every single day. So as long as we continue to hold this trade, this white line will continue to go up and up and up until we meet our maximum profit. Generally, though, we do not like to hold our contracts all the way to the expiration. We usually will try to close them out right around at the 50% to 70% mark, and sometimes down at the 30% mark, depending on what kind of price risk we think we have. But this is holding relatively stable. Now, we had to adjust this trade. In other words, our current price is 139.47, which is right in the center of this, what we like to call our profit graph, our profit picture. We love profit pictures. Profit pictures are extremely important, not only for determining when adjustments are necessary, but it's also extremely important to see exactly where our profit and loss figures are, because remember I showed you that if the price gets up to our break-even points, we need to do an adjustment. And we had to do an adjustment on this trade because the price had gotten very far up the line here, and we needed to adjust our trade so that it comes back towards the center. Being in the center of this profit graph will ensure that you are always in a profitable position in a trade. It doesn't mean that you're always going to have a profitable trade. It only means that if you do adjustments at the right time, and the time of your adjustment is very, very important, then you will never get hurt really, really bad in the market, and you put yourself into a position where you can be profitable. So this is typically what the winding down of a very, very good trade will look like. You will be making money every single day. You will have a very positive profit position, and as you can see from this, the current price is $139.47. We're making $148 a day, but even if the price were to move against us by 2 points, we're still making $100 a day. And if it goes down by 2 points, we're making $130 a day. So either way, this was a very profitable position that we closed out. And that's what it looks like. That's what a profitable position will look like. And that's exactly what this graph will show you, is that over time, your position will become more profitable and more profitable and more profitable, because that option, when it gets closer to expiration, will lose value. You've sold that option to someone else who thinks that the market was going to go in a certain direction. It didn't, and you were able to collect that time premium for that contract. And you can look at this in a different way. You can look at this like an insurance company. Insurance companies will take a look at your house, and if your house is, let's say your house is worth $200,000, the insurance company will say, okay, to insure your house, we will come out, and if it burns down or whatever, we'll pay for it, whatever. And the premium that you'll have to pay on an annual basis is $450. And you say, that's not a bad deal, actually. I pay $450. If my house burns down, they pay me $200,000 for the house. That's not a bad deal. Well, guess who makes more money? The insurance company or you? The insurance company, obviously. Well, the insurance company makes money because they write policies. It's just like writing an option. They know that the probabilities are in their favor when they write that contract with you. They collect the $450 premium to insure your house. Well, guess what? They do it over thousands, hundreds of thousands of properties, and they know exactly what the probabilities are that one of those houses is going to burn down. The fact is that it's extremely low. The probability that your house is going to burn down is extremely low. And we go back to this trade tab for a second, you can see the analogy. It's just like this. Let's say you buy the $60 strike price for 8 cents. Well, the probability is that it's ever going to be worth any money by the third week of May when this option expires is only 3%. When an insurance company insures your property, what do they do before they insure it? Usually they send someone out to take a look at it. You know, maybe they'll take a look at, they'll come on the property, they'll take a walk around. Very few of them even go into the properties. They just kind of drive by, maybe take a picture, and that's it. If the property looks like it's fairly well kept, then they're going to insure your property. And they know they're going to collect that $450 premium. And they know that the probabilities of your house burning down because you've been able to keep it up is extremely low. And they're going to keep that $450 premium. You don't get that back, right? So they keep $450 premiums on thousands or hundreds of thousands of properties. And that's how they make their money. They just collect the premiums. Well, that's what we're doing in the market. We're basically we're selling these contracts that have extremely low probabilities of ever being worth anything. And as these options continue to erode over time to the point where they are worth almost nothing by expiration, we get to keep the premiums just like the insurance companies keep the premiums on the houses that they're underwriting. But just like an insurance company, though, every once in a while, guess what happens? A house will burn down. Well, because they've collected premiums on so many different properties that they're able to easily pay for that one property that does burn down. Out of 10,000 properties, maybe one burned down. Well, they've collected, $4.5 million in premiums, and they only had to pay out $200,000 once for a house that burned down. Who's making money? Well, the insurance company is. The insurance company is making a lot of money. And that's exactly how you can take a look at this business. We're going to be selling these options, collecting the premium, just like an insurance company collects the premium, and then we're going to protect that investment or that premium and writing that contract by buying another option. Because we cannot write thousands and thousands of these contracts, thereby ensuring, just like an insurance company does, we do have to hedge our. But it's basically the same thing that an insurance company does, is that they will actually go out and purchase other contracts and hedge their investments through their own investments and hedge their insurance fund and their insurance premium collections through other investments, so that if let's say an entire section of a city gets burnt down for some almost extremely low probability event, they still have the money that they need in order to pay the homeowners. So there are extremely low probability events that do occasionally happen, and that's why we take both sides of the trade. We don't sell just the call options. We sell the calls and the puts. And the reason that we do that is, well, think about this just for a second. Now, an insurance company, they're only taking the premium on one side of the trade. They're going to say, okay, if your house burns down, it's just like writing a put option. If the price of the stock goes down, we'll pay if your house burns down, and if you're the writer of an option on a put option, and the price of the stock goes down, well, you're going to have to pay up on it. But unlike an insurance company, we can take both sides of the trade. We can sell the calls and we can sell the puts. And guess what? The price can't be in both places at one time, can it? It can only be in one price. So if the price of the stock actually goes up dramatically and this side of our position gets hurt, well, we've got a profit then. If the stock is going up, that means that our profit position on this side is very, very good. So we made a profit on this side even if we lost a little money on this side. And if you take a look at the adjustment CD, you'll see exactly how we can even, salvage the more profitable position on the upside and still make a profit on the downside too. It's really an amazing process. So that is, the introduction to our system. I can tell you without a doubt that this may seem, if you've never dealt with options or stocks before, that this is going to be a very strange process for you. That you may have to review this video several times in order to understand really what's going on and how we're doing our trades. But once you understand exactly what we're doing, you're going to see that this is the most profitable system of trading for monthly income and trading for building wealth that you can possibly find in the market, bar none. It doesn't matter what the market does, we can be prepared for it. If the market goes up, the market goes down, it doesn't matter. We're going to make money. Every once in a while, something weird will happen, and you might lose a little money. I'm not saying that you're going to be 100% profitable every single month, but you're going to have the highest probability of being profitable than any other system out on the market today. And I'm not saying that you're going to be extremely, that you're not going to make millions and millions of dollars with this either. This is not what the system is about. If you want to try to shoot for the moon and try to make millions of dollars, on a $1,000 bet, then go ahead and buy a call option on a stock you think is going to double in price. But that's an extremely low probability event that will probably never happen. And you can spend lots of thousands of dollar bets and not have any money returned to you. And that's exactly how the majority of stock investors, and especially option investors, go after this market. Is they think, it's only $1,000. I'm going to put down, I'm going to buy some call options on IBM. And then what happens? IBM doesn't do anything. It goes down. They lose the entire $1,000 bet. And they say, I'll get the next one. They put another $1,000 down on. They put another $1,000 down on. And then maybe after $10,000 spent, they get maybe one winner that gets them $3,000. And they've still lost $7,000. So I'm not talking about gambling in the market. I'm talking about managing, building, and profiting from a monthly portfolio that'll bring you income. Because remember, there's only two absolute rules in the market. Only two. Number one, prices will fluctuate. As far as options go, prices will fluctuate, options will expire. And what we do is we profit from both of those. We don't care what way the market moves. Remember, markets will fluctuate. We don't care. We are setting up our trades so that the prices do fluctuate. We don't care if they fluctuate. So we're taking advantage of rule number one. The second rule is options expire. We are taking advantage of that by playing options so that they can fluctuate and profiting from them on a daily basis over time so that we can make our maximum profit before expiration of those options. So we are taking advantage of the two major absolute rules of the market. And you're not going to find this information anywhere else, ever. You're only going to find it really right here. You really have to dig into this material and understand it in order to profit from it, and you are set for life. You're going to be able to make a monthly income from the markets. And the amount of income that you decide that you want, is really just a matter of how much capital you have available to invest. That's it. I know guys and my students have, are generating $5,000, $10,000, $20,000, $50,000 a month. It's only you can generate as much as you want. If you're making $2,000 a month in your job, you could easily replace that with an account of just $10,000. 20% returns a month are not impossible. You may not get that every single month, but you could generate that kind of return on a consistent basis, maybe over a period of a year, and you might have one losing month or two losing months or whatever. But if you follow the game plan that we're showing you, for monthly income and wealth building, there isn't a better way to trade. So anyway, I hope you enjoyed this introduction. We are going to get into real specifics here on exactly how we set up our trades. The first thing that you need to learn are these little guys down here, the delta, the gamma, the theta, and the vega. And we're going to do our next videos on that, and then we're going to go right into trade selection and strategy and portfolio building. These are absolutely the critical components and fundamentals of our system and how we actually start building trades. And like I said, if you do need to understand a little bit more about option contracts, more than what I've told you so far, pick up a good book on options, and I'll have some specific recommendations in our members-only website that you can take a look at. But get to understand exactly what an option contract is, but I think you should have a pretty good foundation at this point. And as always, guys, trade with confidence.